Let's log in into the trading account. And then we will see how do we select an option contract and place an order to buy or sell. Okay. So almost in every trading software you have the same facility. This may be a little bit of can be different, not more than that. So what I do is I add in script first. Let's say I am interested in let's take an example of stock, then we will take an example of currency. So let's say I'm interested in Infosys. So I added Infosys here. Now this is the price for share of Infosys, that is one shares price, that is the current market price of the share. If you want to buy a stock, you have to pay 1157 rupees and 25 paisa. And let's suppose if I want to buy an future contract, okay, so I am interested in a near month future contract for Infosys that will expire on 28th of July. I can see here. Now this is trading at 1165 rupees 35 paisa. Okay. And what if I am interested in options? Okay. So I have to see before buying option what price do I perceive in coming future. So where the price may go. Okay. So let's suppose if I believe that the price may go above 1150, it will remain 1150. So I can buy a call option for 1150 strike price. So I can make a deal at 1150, right? Let's add an option chain here for Infosys. So we have now an option chain for Infosys. Now see carefully here. So we have the spot price here at the top. We have the future price here at the second position. And then we have the Infosys. You can see the NSCFO, that is National Stock Exchange, future contract or future and option. So we can see here it is the exchange we are selecting is National Stock Exchange, and the segment is future and option. And this is Nifty 28 July. 28 July is the expiry, 2016. And CE stands for Call European. Okay, so there are two kinds of option contract, American options and European options. So we will understand the difference later on a little bit. So this is a Call European. Okay, and we have the strike price. This is 1000. So the current market price is 1157, and if you want to buy this underlying share or the stock at a lower price, okay, so you put the strike price at 1000, or you can go for 1020. So if you are buying 1020 strike price, you have to pay 165 as the premium. In that situation, your break even will become 1185, and a lot of premium you have to pay. And this is for one option contract, and the lot size is 500, so you have to pay 165 into or the multiplied by 500. So this much of the amount you have to pay to buy one lot of Infosys option contract with a strike price of 1020. So this is too much in the money. Now let's move on down. So you can choose any strike price. So basically the concept is you have to understand If you are thinking the market will be bullish, then you will be buying a call option. Fine. So, but then also you have to understand that where do you expect the market to, close at the time of expiry. So if you believe the market will close around 1200 near the expiry, so you can buy any contract below 1200, and including premium, the break even should be less than 1200, right? But then if you are going more out of the money, you have to pay lesser premium, and you are going in the money, you have to pay higher premium, because in the money contract will have intrinsic value as well as the time value, and out of the money contract has only what? Time value. Now, so as we go, higher with the strike price, we can see here the hold on. So we can see here the premium is reducing. So if I go to 1160, okay, which is more than the spot price of shares, the premium you have to pay is only 44 rupees. So the break even will come to around 1204. But the amount invested would be to buy a contract will be much cheaper as compared to 1020. So if I'm buying 1020, strike price, so let's say strike price or the exercise price is 1020 and the lot size is 500, so you have to pay around, this is too much, 510,000. That means 5,10,000 to buy one lot. I'm so sorry, I was wrong. The premium I have to take, the premium is 165 here. I'm so sorry. The premium you have to pay to buy one lot. So premium is 165. You don't have to pay the strike price. So I'm checking strike price is 1020. So your premium would be 165. The lot size is 500. So the total premium you would be paying is 82,500 to buy one lot. And what would be your break even? So break even point would be around, the strike price. So break even point is your strike price plus the premium. So 1185. And what is the spot price right now? That is 1154, I guess. So this is the spot. So before the expiry, so what is the date of expiry? 28th of July. So before 28th of July, if this share price, this stock price of Infosys, so this goes to 1185, you'll achieve the break even. And after that, you will have profits. So at what price you bought? Strike price is 1020 and premium you paid was 165. So you're paying extra. So we took yesterday's example, in last class example, you understand, we took the example of a property. A property was priced for 1 million. And if you want to buy a call option, so you have the right to, buy the property and no obligation to buy. So the price for the property was 1.1 million and 0.1 million was paid as a premium, so premium was extra. So total cost is 1.2. So that is your break even. So same here. I am planning to buy at a cheaper price, at 1020, not even at a higher price. So my premium is higher here. The intrinsic value plus the time value. So this comes to 1185, which is my break even point. But in second case, if I say at 1160, the premium is 44. I see here for 1160 strike price, the premium is 44, right? So what happens is the lot size is 500 and the total premium would be how much? The total premium would be 22,000 to buy one lot. And what is your break even? The break even is little higher, that is 1204. Right? Now what if on the expiry the spot does not go to, let's say, 1200? It remains below, 1085. In that situation, on the date of expiry, your break even is not achieved. So below this thing, it's all your loss. So your 165 rupees premium will be gone. So this 500 into 165, that means 82,500 entire money will become zero. Okay, so whatever is the price, let's say price falls further below. Let's say it falls, instead of going to 1185, it went down to 900. Even in that case, your maximum loss will be 82,500. So wherever it is, the price will be, your losses will be limited to the amount of premium you paid, not more than that. Okay. Now, if the price goes to 1190, just suppose on the date of expiry, now this contract will be giving you a profit of around 5, and this thing will be still giving you a loss of how much? You think it's 14? No, it will be all zero. It's not like that you'll be getting a loss of 14. Now why it is so? Because on the date of expiry, you have purchased a strike price of 1160. I'm so sorry, you have purchased a strike price of 1160 and the market is above this thing. Yes, you will have a loss of 14 only. If the market remains here at 5, you're making some money. But if the market is below your strike price, then entire money becomes zero. You will have no intrinsic value and you will have entire money becoming zero. Let's say give you a couple of examples. What happens when the expiry is what? So let's suppose, I'll check it. If the expiry is, let's suppose, 1190. So you will make 5 rupees profit as the break even is 1185. And if in the second case you are buying a strike price of 1160 and the market goes, the expiry, that means the share price from 1154, it increases to 1190. In that situation, what will happen? In the second case where you are buying the same Infosys contract at 1160, so your break even is coming to 1204 because the premium is 44. In that situation, you will have a loss of 14. Why it is a loss of profit 14? Because you bought at 1160, market closed at 1190. So in that situation, how much you will be getting? So let's check out. I calculated other way. ध्यान दीजिएगा. So I purchased at 1160 what? Infosys contract, and on expiry, the contract was trading at, the stock shares were trading at 1190. So you bought at 1160. Now shares you can take delivery or you can do a cash settlement. So just erase all the things, understand this thing. You have purchased the Infosys share which was trading at 1154. You purchased 6 rupees costly here today. Okay, I'm buying costly, no worries. But on the date of expiry, the price increased. Price increased to what? It increased to 1190. So what price? The share price. Now if share price increased to 1190 and you're buying at 1160, in that situation, what is the difference here? The difference here is 30. So you purchased at a lower price and expiry is 90, so it's 30 rupees high. So this could be your profit. So remember from our previous class, the premium equals to the intrinsic value plus the time value. Now the intrinsic value is what? Intrinsic value is the spot minus expiry. You know, the spot minus the strike price. I'm so sorry. Now remember, what is the intrinsic value on, let's say, 28th of July? So 28th July, just I think. Now this is on 7th of July. Now in 7th of July, if I see here, so I go to this contract. See carefully here. So on 7th July, I am buying this strike price 1160, and I see 7 July. 7 July, and the premium is, let's suppose I am buying 120 contract, so premium here is 165. Okay, and the intrinsic value should be the spot minus the strike price. Okay, so here the spot price is 1654 and minus the strike price is 1020. Okay, so this would be my intrinsic value. Okay, so 134 is my intrinsic value. Then what should be my time value of money? So time value of money is what? Intrinsic value minus the premium. So remaining is my time value, I can say broadly. So if devise 34 from this thing, I'll get the time value. So this will be around 31. So 31 is my time value, or remaining, let's say 154 was my, so 134, I guess, how much was that? Hold on. So 134 was my intrinsic value. So from the formula, I get it, the premium equals to 165, right? For the same strike price, this 1020. Fine. So why is it so? So if I put it into two columns, let's put it into two columns rather. So I'll keep it premium. I'll keep it intrinsic value and time value of money, right? So premium here I paid for the strike price. So remember strike price. So put it here, strike price. So strike price was 1020. Okay. Oh, I'm so sorry. Aha. Hold on. The premium I paid was 165, right? So what is the intrinsic value in this premium? The intrinsic value is always the spot minus the strike. So spot is 1011 and the strike price is 1020. So I can say is 1011 minus the strike price. So this is 134, and what is the time value of money? So time value of money is premium minus the intrinsic value. So 31 is my time value. So why do I have a time value here? So why do I have a time value here? I have a time value here because we have around 21 days remaining for the expiry. Now if we talk about on 7 July, I talk another contract. So I'm buying at 1160, and what is my premium? Premium is 44. Now what is my intrinsic value? So spot minus strike. So spot is this thing minus strike. Now it is going negative. Now I told you the intrinsic value cannot be negative because your assets value cannot go negative. The property value cannot be negative. It can be maximum 0. So in that situation, what happens is the intrinsic value will be 0. Now what will be my time value? So the entire premium here is, if I do simple, the intrinsic value minus the premium I get remaining as the time value. So I put simple here, the premium here as the time value, 44 rupees. So here I am paying more time value, and in the money I am paying lesser time value. Why? Because in the money contracts are less volatile than the out of the money, so the risk premium charged on out of the money contracts is higher. Because of the time value of premium, as a premium we charge it, is higher in out of the money contract as compared to deep in the money, right? Now let's understand what happens on the date of expiry. So let's say it is 28th of July, and the spot price means Infosys shares price. Infosys share is, let's say, going to at 1190. Okay, so I better put it here, 1190. So spot here is 1190. Now what is the strike price? So I can shift it somewhere like here. Fine. So the spot price, or I will rather do one thing, is I shift it here. Here. And 28th July. Yes. So it's telling that on 7 July Infosys was 1154, and on 28th of July the Infosys is 1190. So expiry is 28th of July. Now, so which strike price I bought? I bought share at what price? So let's suppose in the first case I bought at 1020, right? And what should be the premium? Now premium should be equal to intrinsic value plus time value. So let's check out the intrinsic value. So what is the spot price on the date of expiry? The spot price on the date of expiry was 1190. Fine. Minus the strike price. So strike price is 1020 for the same contract. Remember what I'm doing here is I'm calculating for the same contract, because I bought Infosys share or Infosys call option at a strike price of 1020. So to close the contract I have to sell the same strike price option contract. Okay, so listen to me carefully. I bought at 1020. So I have to see on 28th of July what would be the premium. Okay, so when I'm buying, I'm paying premium, and when I'm selling, I will be receiving premium, and the difference will be my profit. Okay, so I'm recalling, when I am buying, I'll be paying premium of 165, and I'll be receiving the premium on expiry, whatever premium is there, and the difference would be my profit. So what should be the premium? Theoretically, the premium should be intrinsic value plus time value. So the intrinsic value would be a spot price on 28th of July, which is we are assuming that will go to 1190. So my intrinsic value will be spot minus a strike. So spot, yeah, there was some connection problem. Yeah, I'm back. So I was telling I'll be receiving premium whatever when I'm selling the contract. So what should be the premium? of 1020 strike price, same strike price. So if I check into the software, this same strike price 1160, okay, or 1020 here, this will be trading on 28th of July. The name is 1020, so I'm buying at 1020. The same contract which has a premium of 165 right now may be different on the date of expiry. As the underlying asset price goes up, the share price goes up or down, the premium changes. Why? Because the intrinsic value increases or reduces, and time value also reduces. Now, so what should be the premium on 28th of July for a strike price of 1020? So the premium is intrinsic value plus time value, and intrinsic value is spot minus strike. So the spot is 1090, I believe, and strike price we took was, we have, purchased before was 1020. So the intrinsic value is 170. And on the date of expiry, the time value will be how much? 0, because you don't have any day remaining, so you cannot charge any interest time value. So it will be 0. So technically, the premium should be 170 plus the time value. The intrinsic value plus the time value. So 170 will be your premium. Now what should be your profit? The profit would be the premium paid and the premium received. So you paid 165, okay, and you sold at 170. So 170 minus 165, 5 rupees profit you are enjoying, right? Why this is? This is because the price increased to 190, more than 1020. Okay, if price goes much higher, let's say price goes to 1250, in that situation your profit will become 65. Why? The intrinsic value will be 2030. Why? Because the Infosys spot went to 1250 and you bought at 1020, so the difference is how much? 230. So 230 is the intrinsic value. That will be the premium you're gonna receive when you are selling the contract. So you remember, the call seller receives the premium. So you previously bought the call options, you purchased, so you paid 160 rupees as premium, and when you sold, you received 220 as a premium. Okay, and the difference between that is 65, which is your profit. So let's remember here, I am buying at 165, and let's say 5 minutes later on, market increases and it goes to 170. Let's say the Infosys price is 1165, it goes to 1175. 10 rupees increase in the share price. Quite possible this will also increase 8-9 rupees or 10 rupees. So it goes to 175. So you bought at 165, you sell it 175, you make a profit of 10. So 10 on one share, one option, and you are buying a lot of 500, so you would be receiving around 5,000 as a profit. So same here, the concept is, I'm keeping the contract till expiry. I'm not selling it after 5 minutes or 10 minutes. If you want to sell, you can do it, not a problem. But I want to sell it after, let's say, at the time of expiry. So at the time of expiry, the time value will be 0 in the premium. And the premium will comprises of only intrinsic value. And intrinsic value is the spot minus a strike. And the spot was 1250, strike was 1010. 230 would be the premium expected. I'm expecting. Normally this should be there. There might be 1 or 2 rupees difference, not more than that. And if you sell it, you make profit of 65. Okay. Now what about if the market is not 1250, the market is expiring at, let's say, 1050. In that situation you will lose 135. Why? Because you purchased at 1020, the market went to 1050, it is 30 rupees above. So in that situation there would be some intrinsic value, that is 30 rupees. So what happens is you paid 165 and 30 rupees is my What? 30 rupees is my intrinsic value. So this is my premium. So because time value is 0 on the expiry, so forget about time value. So I get 30 rupees premium when I sell it, and I paid 165, so my loss is 135. And how about if the market goes below 1020? So let's say market goes to 900 on expiry. So will I lose 285? No. I paid 165 and remaining 120 more I will be paying. So my loss will be 285. No, nothing's like that. If market goes below 1020, I will not execute option contract. I will not exercise my right. I'll leave it. So in that situation, my maximum loss will be 165. I will not exercise it. So losses are limited. Okay. Now, let's understand the concept. If on the date of expiry, let's say the price goes to 900, what will happen to the premium? In premium includes spot price minus strike price. Remember, the intrinsic value cannot be negative. The intrinsic value will be 0. And the time value will be also 0. The premium received would be 0. The maximum loss will be 165, which you paid at the time of buying. So getting my point? What happens if the price goes to 900? Or let's say price goes to even 1000? Both the situations, wherever it goes, 200, 300, anywhere, the intrinsic value will be 0, because intrinsic value cannot go negative if the price falls below 1020. So intrinsic value is 0, time value is 0, so the premium received from selling the contract would be 0. So at the time of buying you paid 165, at the time of selling you would be receiving 0 premium, so your total loss will be 165, not more than that. And if at the time of expiry it is increasing, as I said, if it is going to 1300, you will be making profit. Why you will be making profit? Because you will have spot minus strike, and this is your intrinsic value you're going to receive. Time value will be 0 on the date of expiry. So your profit will be 115. Why? Because at the time of buying you paid 165, and at the time of selling, okay, the market went to 1300, so you're receiving premium of 280. So the difference is 150, which is 115. That is your profit. Okay. So suppose if this increases, the spot price 1165, this goes to 1300 after 1 month. Okay, what will happen to the premium of this thing? 165. In this thing we have 31 rupees as time value and 134 as intrinsic value. Okay, so I'm so sorry, this is 1157. So we have 1157 minus 1020, so the remaining I guess 133 is I guess the intrinsic value, and remaining 32 is your 32 or 35 is just calculated, is your time value of money. So today the time value of money is there, but on the date of expiry the same contract will have no time value of money. So suppose if this goes to 1300, the spot price goes to 1300, the Nifty share price, the Infosys share price goes to 1300. In this situation this will have the intrinsic value of 280. So 280 will be your intrinsic value, and when you sell it you receive that. You remember, when you are buying a call option you are paying 165. When you are selling call option you are receiving 165. So sorry, you're receiving the premium, whatever premium is on that date. So on the date of expiry I'm expecting the market to go, the price of Infosys goes to 1300, so the premium will be around 280 because of the difference between a spot and a strike going higher. Okay, the spot going higher, so the difference will be 280, and there's no time value, so 280 will be the premium here. If you see this terminal, it won't be 165, it will be 280 at least if the Nifty Infosys is going at 1300, because the strike price is 1020. So the difference is 280. So when you sell you receive 280, and when you bought You paid 165. The difference of 115 will be your profit, 150. Okay, so this is all about buying and selling the call options. When you buy, you pay premium. When you sell, you receive premium. The difference is your profit. And how the difference changes? As the share price goes up or share price goes down. If suppose the market goes below, let's say 1020, it goes to 1000. In that situation, there will be no intrinsic value. Intrinsic value will be 0 because it cannot be negative, right? And the time value will be 0. So premium here would be 0. Like you say here it is 0, so it would be 0 here. So the premium will be 0 here. When you sell, you will receive 0. You remember, when you buy call option, buyer of the call option pays premium, seller of the call option receives premium. So when you sell, you receive and close your position. So you receive 0. So entire 165 goes to losses. Okay, so this is how you trade an option contract. Now, if we talk about second strike price, 1165, I'm deciding to buy at 1160, and if market goes to 1300, in that situation, I'll make a profit of 96. Why? Because price went higher. What will be my intrinsic value? So this is my strike price, and what should be my intrinsic value? The spot minus the strike, 1140, and what should be my time value? 0 on the date of expiry. And what should be my profit? I paid around, I paid, profit would be, the premium I'm receiving 144 and I paid 40. So I'm so sorry, the premium I'm receiving is 140 when selling it, and paid was 44. So 96 will be my profit. Simple. If market goes below, not 1300, let's suppose market goes below, 1160. So let's say market goes to 1150. See, in that situation, I'll have a loss of maximum 44. Why? Because there will be no intrinsic value. Intrinsic value will be 0, time value will be 0. So when you sell it, you will receive nothing. And when buying, you paid 44. So the difference is your profit or loss. So you paid 44, so maximum loss is 44. So below 1160, the premium will be nothing, 0. So you're selling it, you're having 0. So in other words, you can say is, if the market is below your strike price, okay, the shares are trading at below your strike price, your price, you don't execute. In that situation, your maximum loss is the premium amount you paid. Okay, and even if you execute in the market, the shares will be trading at 0. The contracts, the option contract will be trading at 0. The same strike price, because no intrinsic value and no time value. So hopefully till now you understood how the thing works. Now we will take some simple calculations to make you understand this thing more. Now let's suppose Nifty is trading at, let's suppose Nifty is trading at 8,200. Okay, so this is Nifty index, right? Or Standard and Poor 500 index, anything. So this is the underlying asset. So spot price today. This is today. And I feel, this is my expectation, is that market will remain close above near the time of expiry at around 8,400. So I decided to buy a call option. So I am buying call option. Okay, so I am buying call option of strike price. So exercise price would be, let's say, 8,250. So this is an out of the money, more than the market price, and the premium I'm paying is, let's say, 40. So my break even would be how much? 8,250 plus 40. No. So on the date of expiry, let's suppose the Nifty went to 8,500, what will be my profit? In second case, let's suppose Nifty went to 8,400 as we expected, what will be my profit? And what if Nifty went to 8,300, what will be my profit? And what if Nifty went to 8,200, what would be my profit? And what if Nifty went to 8,000, what would be my profit or loss? So we have to calculate. So this is what is my expectation, but actually this anything could happen. So let's suppose I'm buying call at 82.50 and the premium is 40 I paid. So on date of expiry, if market goes to 8,500, what would be my profit? So I bought at 8,200, market went to 8,500. Fine. So I bought at 80. So I'm selling it when the market is at 8,500, and I'm bought at 82.50. So the difference is 250. Now this is, I can say, is the intrinsic value, because this is my strike price and this is the spot price, and a spot minus strike is my intrinsic value. So 250 is what I'm gonna receive, or either in simple words I can say is I bought at 82.50. This is the strike price I am buying in simple words, and I'm selling at 8,500 when the market is 8,500. So I'm buying when the market is at 8,200, but I'm not buying at 8,200. Remember this line. I am buying at 82.50 when the market is 8,200. So I am not bothered about what is market today. I'll bothered about I'm buying at what strike price. So I'm buying at 82.50. So this is my buy price. And when I'm selling when the market is 8,500. So market is 8,500. So intrinsic value here will be 250, or you can say this is my, payoff. And what will be my profit? So I have paid a premium over this thing of 40. So my profit would be how much? 210. Now, in the second case, let's say I am selling when the market is at 8,400. So I bought at 82.50. I'm selling 8,500. So 150 is my profit or payoff, I can say. And the premium I paid was 40. So in second case, my profit will be around 110. So tell me what would be my profit if market goes to 8,300 or 8,200 or 8,000. What will be my profit or loss? Calculate it and tell me. Now take 2-3 minutes or 5 minutes, calculate it yourself, and then tell me and match the answers with my answer. Is it correct or wrong? Now, so you have paused and did it, calculations. So what happens here is, if we talk about 8,300, yes, we bought it. We are selling at 8,300. We bought it at 250. So I'm getting 50 rupees at payoff, and my premium minus it goes, and I guess 10 rupees profit. But what was 8,200? 8,200 is like spot. Say I'm selling at 8,200, buying at 8,250. So there can't be like negative 500 as intrinsic value. So this thing I cannot receive, or I cannot have losses. So the intrinsic value which I'm calculating here is 0. And what would be my loss? The premium I paid. So payoff what would be 0, and the premium I paid was 40. So my loss will be 40, not more than that. In case of 8,000 also, my maximum loss will be 40, because premium I will get nothing. Okay, so I can, in easy word, I can say that as if the market goes below your strike price, you do not execute the option, and your maximum loss is 40, not more than that. Right? Now let's take another example. Another example of what? I want to take. So let's take a live example from currency derivative. So let me log in to my trading account. So logging in. And I want to go for a currency derivative. So I add a script, go to currency, which one? Let's say USD INR. And add a blank window here. And expiry, I want to check the near one. An instrument, I want to take the calls or puts. Show. So we have different strike prices here. Add. Look at this. For currency, we have different strike prices here. Now, what is the strike price? So what I can do is rather I'll add a blank window and I'll add a script. Let me see the futures. So add. Now this is the spot price or the underlying asset, I can say. In fact, it's not the spot price, the currency derivatives price. Let me see if I have a spot here. No, we don't have spots. Spot, you have to take the RBI reference rate. Anyway, this will work as a spot. Same process. Now I want the option chain for this thing. So I'm not getting an option chain here. And script, currency, expiry near, futures. I guess I go to spot here, show, sell by USD INR. Now spot, I got the spot, So this is the spot, and this is the spot, and I'll add option chain here. Oh, come on, option chain should be there for currency derivative. This is a spot, so what I'll do, add the another way. So I'll go to instruments, calls, and near, show all, select here, add. The spot is 67 rupees 40 paisa and 00 pips. Fine. Now, the lot size is 1000 units. Okay. $1,000. Now, so the current price is, I guess I have to check it, cross confirm what's the lot size. Hold on for a second. The lot size is $1,000. Now, what happens is, what is the underlying asset price? 67.4. So if I'm buying a 67.5, it is very near to the at the money. Okay, so with the 67.4 strike price we don't have, we have 67.5 strike price. So I can buy 0 or I can buy higher, okay, or lower. So I can buy at the money, out of the money, or in the money. Okay. So what is the premium I have to pay to buy the at the money contract of 67.5? So as we saw, the spot price for USD INR pair was 67.4000. Okay, and I'm planning to buy a call option with a strike price of 67.5000 now, and the premium I'm paying is around, for this thing I'm paying around is 35 paisa. So the premium here is 0.3500. Now what happens on the date of expiry? Let's say on the date of expiry the spot goes to, yani ki this thing increases. So on the date of expiry, let's say the spot goes to 69. This is too much down, but let's say it goes to 69.0000. In that situation, I bought at 67.50. I'm selling at 69.00 something. So this is my buying price. I'm not worried about this spot price now. I am buying this spot price at a higher price. Okay, at a higher strike price. I'm buying a call option at a higher strike price than the spot price, out of the money. And I'm paying a premium of 35. So on the date of expiry, the market goes to 69.00. So what should be my premium? So for that, I have to calculate the intrinsic value. So intrinsic value is the spot minus the strike. Or I can say I bought at 67.500 and the spot is 69. The difference is my payoff, and minus the premium is my profit. So my payoff will be 67.50. So the difference here comes to around 1.50, and the payoff would be minus 0.35. So this comes to 1.15 will be my profit. As simple as that. Into lot size. So lot size is, let's say, 1000. So you will be receiving around 1000 rupees and 1015 rupees, 1015 rupees you will receive. It's as simple as that. If the market falls, let's say on the date of expiry, if the market goes to, let's say, below 67.5, market goes to 66.00. In that case, you don't exercise the option contract. Your maximum loss is 0.3350. And there will be no intrinsic value, so the entire loss you have. So 67.50 was your buying, because the intrinsic value will be not negative, so it should be 0. Okay. So in that situation, the loss would be the premium you paid, that is 0.03500. And if the lot size is 1000, so that means for one lot you might have paid 350 rupees. So this will be your maximum loss. Not more than that loss you have to bear wherever the market goes. So if the USD INR falls, so that means USD become cheaper. Your maximum loss would be 0.3500 per option contract, and lot size was 1000, so maximum loss will be 350. As simple as that. So you have limited loss, unlimited profits on call option you are buying. Okay, now let's understand this thing from one more angle. What happens to the seller of call option? Let's suppose the spot price of Nifty is 8,200. So this is the index. Okay, and you are buying call option at a strike price of, let's say, 8,100. So this is the in the money call option, and you are paying premium, that is, let's suppose 150 you're paying premium. And at the same time, so when you are buying a call option, obviously somebody is selling this contract to you at 8,100 strike price, and this guy will receive the premium you paid, 150, when signing into the contract. And how do we close the contract? The buyer has to sell and close, then the seller has to buy and close, if you're doing the cash settlement. Now, so let's suppose on the date of expiry, the market goes to 8,300. What will happen in this case? Now check out. So you have to sell the call to close the position. So when you sell the call, you receive premium. So which one call you will sell? The one you bought. So you bought at 8,100. So you have to sell this one 8,100. And the premium you're gonna receive. So what would be the premium? Remember, the premium would be the intrinsic value plus time value. On the date of expiry, time value is 0. And the premium would be the intrinsic value. So spot is 8,100. And the strike is, sorry, the spot is 8,300. This 8,300 on the date of expiry. And the spot, the strike is 8,100. So the spot minus the strike price. So sell call at 8,100 strike price. So this is this exercise price, the strike price. So the difference would be 200. So spot is 8,300 on the date of expiry. Spot on expiry. So the intrinsic value is your premium. Now, what is the profit? Profit is difference between the premiums. So you paid 150 and you're going to receive the premium when you are selling the call. So the difference is 50, your profit. And let's check out the seller of the call option. So he has to buy the call to close the position. So which one he will buy? 8,100 strike price. The premium would be how much? Same. Obviously, the premium is difference between the spot minus the strike, which is 200. So this guy has to pay. Time value will be 0. So he received 150 and paid 200 to close the position. His losses would be 50. So one is making money and another one is losing money. So one is making money, okay, and this guy is losing. Now let's take one more example. What if the price goes down? Okay, so what I'll do is I'll erase it. So what happens if the expiry, instead of 8,300, this is, let's say, 8,000. Price goes down instead of going up. You were expecting the market to go up. When the spot was 8,200, I analyzed on 7 that on the expiry it will go to 8,300 at least. But the spot on expiry of the contract, that means 28th of July, it was 8,000. So the buyer has to sell and close. The market went to 8,000. Oh, I'm so sorry. You have to sell the same contract, 8,100. So when you sell, you receive the premium. What should be the premium? The time value will be 0. And intrinsic value cannot be negative. The spot was 8,000 and the strike was 8,100. So spot minus a strike. So that will be minus 100. So minus 100 cannot be premium. The premium will be maximum, the intrinsic value. The spot minus a strike will be minus 100. It cannot be negative. Intrinsic value cannot be negative. So the intrinsic value will be as low as 0. So the premium is 0. So in that situation, you're going to receive is 0. So you paid was 150. 150 is your entire loss. And same here, you buy call and close the position. 8,100 call. What would be the premium? As said, 0. So the entire 150 which you received in the beginning, you keep it with yourself. In other words, I can say is, if the market goes below your strike price, the strike price was 8,100, market went below a strike price, anything, even a single rupees, the premium becomes 0. Okay, so in that situation, the buyer has the right to, buy and no obligation to buy. So he will not exercise his option contract, he lapses it. In that situation, maximum loss is 150. And if you lapse it, you don't have to pay the brokerage. If you want to close it by selling, you can close it by selling, but in that situation you have to pay the brokerage. If you leave it, you don't have to pay the brokerage in case of losses. As simple as that. So this is happens while settlement. Okay, so as simple as that. Hopefully you've understand till now how the option buy and sell works. Right? So I'm giving you another problem here. Okay, so let's say spot is 8,000. I'm repeating, I'm expecting the price to go set 7,800. So I was bearish. So I think let's sell it. So get into a short position. So I sold a higher strike price that was out of the money at 8,100. So when I sell a call option, I receive a premium, right? So I received a premium of 50. But as per the expectation, market did not fall. Market went up at 8,050. Now, so expiry was at 8,050 and I sold a call at 8,100. Now what would be my profit and loss? Tell me quickly. Calculate and match with the answer I'll give you. So my answer would be 50 only. Why? See, I am selling at 8,100. So what is my point? My price, my strike price was 8,100. I sold at 8,100. So when I'm selling at 8,100, somebody is buying at 8,100, right? So I remove this thing, so right in front of this thing. So I'm selling calls, somebody is buying call at 8,100 out of the money. So he's gonna pay the premium minus 50. Now what happens if market goes up? 1,050, but it's below the buy call price. So not exercise the option contract. The maximum loss will be 50. So this is my profit 50, not more than that. On the other word, if I say if this closes position by selling, so he gonna receive premium. How much premium he gonna receive? The time value will be 0. And intrinsic value will be 0. Why? Because the spot price on the date of expiry was 1,050, which is below the strike price. So spot minus a strike is minus 50. The value cannot go negative. So minus 50 cannot be the intrinsic values. The intrinsic value will be 0. So you're going to receive 0 and you paid 50, so minus is your loss. Same here. So when you have to close your position, you have to buy call for 8,100 to close the position, and premium paid would be 0, so 50 is your profit. So in shortcut you can say is just think you are a call seller and you're selling something at 8,100. The price is on the expiry is above or below your selling price. Match it. Just check out. The price on expiry is below your strike price. आपके strike price से expiry पे rate नीचे है. अगर नीचे है तो call buyer exercise करेगा नहीं. Remember the example of property. If the property price, we did the deal with the buyer and seller. The buyer was ready to buy at 1.1 million, seller was ready to sell at 1.1 million. The premium extra paid was 1.2 million from our previous class. Okay, in that situation, if the market price goes to, let's say, $800,000, so buyer will not come to execute. So you'll keep the premium. Same thing happened here. You sold at 8,100, market price went down to 8,050. So say no, it went up from spot. So it's not about spot, it's about my strike price from my cost. So if the market is below 8,100, the my strike price, that situation buyer will not come to exercise the option contract. The entire 50 is your premium. And seller of the option contract does not have profit more than the premium received. So limited profit, unlimited loss. Otherwise, if you see the actual calculations, I gave you an example of the actual calculation. Right? So when you sell, somebody is buying call. Buyer of the call pays premium, you receive premium. You close by buying, So when you buy, you pay premium 0 because the market is below your strike price. So there is no intrinsic value, no time value, the premium will be 0. Entire premium you received here at the beginning of the contract is into your pocket. And this guy loses 50 premium. As simple as that. So hope you get it. So let's take another example. Okay, so spot price is 8100 and we're selling a call option at a strike price of 7900. So strike price, fine, 7900, and the premium you received was, let's say, 270 you received. Okay, this is what happened in the beginning. On the date of expiry, the spot price went to, let's suppose, 700, so sorry, 7970. Okay, so what will be your profit or loss? Calculate and tell me, and then match with my answer. See, always remember the intrinsic value is spot minus a strike. Okay, if you buy call or if you sell call, doesn't matter. Intrinsic value will be same formula, spot minus a strike. Okay, so I've given you enough time. So let's say calculate it. You're selling, so you have to buy the call 7900. So in buying call at 7900, you have to pay the premium. How much premium you're gonna pay? The intrinsic value plus time value. So what is the intrinsic value? Spot minus a strike. So spot is how much? 7917 and strike is 7900. So 70 is your intrinsic value. So this is what you're gonna pay. So you pay 70 and you receive 270. The difference 200 is your profit. As simple as that. Okay, fine. So I guess enough for today. See you in next class. Till then, you can do revision